Welcome to our webinar on Economic Outlook, is now the right time to sell your agency? And this is the latest in our series of selling your business webinars. It's great to see so many of you joining us. Hopefully this reflects the level of interest in this morning's webinar, and for those regulars who joined us previously, the usefulness and this content that we're putting out. Many of you probably are quite familiar with who we are, but for those of you who are less familiar, Moore Kingston Smith is a top 15 firm of accountants, tax and corporate finance advisors. We work with business clients right across all different sectors, including not-for-profit and private individuals. But in our West End office, we have a team of 7 partners and about 100 people working exclusively with media and marketing services sectors. So our media specialist corporate finance team specialises in M&A, in particular sell-side advisory, taking sellers through the entire sales process. They look at strategic growth services, so helping businesses to get into shape sort of in advance of a capital event. And they look at financial due diligence, so acting for a number of strategic trade acquirers and private equity houses as well, in the media and marketing services space. Our corporate finance team led over 50 transactions last year, with around a third of those in the media and marketing services space. And we also work closely with our colleagues in that M&A tax team, and that allows us to give a very joined up full service M&A offering to our clients, all delivered, as I say, by sector experts who work exclusively in media and marketing services. In recent months, some of the transactions that we have advised on include the sale of ad agency Creature to Dutch buy and build platform Candid, the merger between brand and culture consultancy, spit that out, People Made and stakeholder communications group Black Sun, as well as the acquisition of creative agency AML by the fast-growing creative group Selby Anderson. We're also part of the Moore Global International Network, which consists of firms in over 100 different countries, and we regularly team up with our colleagues around the world to assist on cross-border transactions and to support clients with their international growth aspirations. In some of our recent webinars, we've explored things such as what potential sellers should be considering when they're preparing to sell their business, sort of getting their business ready for sale, and highlighting the potential pitfalls and how to avoid them and how to sort of ensure a smooth transaction. In our webinar back in May, we focused on integration, so looking at the steps that acquirers take from an integration perspective to ensure that acquisitions will be a success before, during and after the transactions. And you can rewatch any of these on our website. But today we are looking at the impact that the current economy is having on the media M&A market, and we will hear the latest forecast for the economy, although that seems to be shifting sands at the minute, and then discuss what we are hearing from acquirers, investors and agency owners, as well as what we're seeing on transactions at the moment. So I'm delighted to be joined by Abbas Khan, who is Assistant Vice President of Markets and Macro Research, Fraser Bars, who is the Relationship Director for Technology, Media and Telecoms, and they're both from Barclays. Welcome, Abbas and Fraser. And they'll be joined by my colleagues from Moore Kingston Smith, Paul Winterflood, who's a Corporate Finance Partner, and Kat Stone, who is a Corporate Finance Director. For what I'm sure will be an incredibly insightful hour, as they all give their perspective on what we are seeing at the moment. So before we launch into the panel discussion, Paul Winterflood, Corporate Finance Partner, here will be providing our latest M&A update covering the latest deal activity. Do watch out for our full quarterly M&A report, which will be landing in your inboxes fairly shortly after this webinar, and which will go into fuller detail around the key subsectors of interest for investors and notable deals from Q2. Before I hand you over to Paul, a couple of quick housekeeping points. The webinar is being recorded, so please do suggest anyone of your peers that would be interested in this, or anyone who missed it, let them know. We're keen to have a lively conversation in the panel session. It does make it much more interesting if you all ask us lots of questions. If you want to ask questions, please do put them in the Q&A function, not the chat function. They're much easier to keep track of in the Q&A. And lastly, we're always very keen to hear your thoughts and suggestions on topics for future webinars. So please do take a couple of minutes at the end of this webinar to fill our feedback survey in with any thoughts and ideas that you have. So without further ado, I will hand you over to Paul for the M&A update.
Evolved over the summer months, looking at some of the trends, notable transactions. For those of you who joined before, I'd normally conclude with an outlook, but we're going to pick that up in the panel discussion later. For those of you that haven't joined before, just a bit of background to the data. We here at MKS track deals on a quarterly basis in the media and marketing services sectors, and include in that analysis any deals involving either a UK buyer or a UK seller. And so that's the context behind the numbers. So firstly, this first slide is about the number of deals per quarter. So the last webinar we held was in May time. Since then, Q2 was again strong. And the Q3 numbers, those were numbers based up to the end of last week. So there does tend to be a bit of a lag in reporting. So it does look like there's a dip at the moment going into Q3, but we very much expect that to be about the 100 mark, which is an indicator of another very strong quarter. Quarter three, last year aside, does tend to be slightly quieter, but certainly a quiet market is not what us or any other advisors are experiencing at the moment. So based on the number of deals in the market does seem very, very strong. For a transaction to close before Christmas, and so to get into Q4, we probably need to have a deal agreed by now. And so based on what we can see on the market and the number of transactions that we're advising on, hearing about in the general advisor community, unless there's a widespread collapse or a significant slowing of the deal speed now, which would be unprecedented, albeit did happen in 2020, we think Q4 will be pretty strong, which will result in a record year for the sector. That being said, all the way through this year, deals have been, and probably in 2021 as well, deals have been taking longer. Partly that's advisor capacity, mainly on the buy side, but also acquirers. They've been seeing so many transactions over the past 18 months. It has meant that they've been having to say, we can't look at this now, come back to us in a few months. Also on the acquirer side, when there is uncertainty, dragging out on transactions may work in their favor as they want to unpick what exactly is going on and what the economic impact is. So that's probably setting the context for quarter four. However, if there is any change in deal numbers, we're not expecting it to show in the numbers at least until quarter one or quarter two of next year. Since the start of the pandemic, private equity is basically underpilled deal doing in this sector, with institutional investors making new investments and also backing their existing companies in their buy and build strategy. So this slide looks at the proportion of deals that have private equity involvement, either directly in the case of Talon, for instance, that were sold by Mayfair Equity Partners to Equistone, or indirectly, so where a business that has private equity investment, say the marketing practice, they continued their buy and build strategy and acquired an Australian-based ABM agency called Rombi. What you can see from these numbers, though, is that quarter two and quarter three both have seen an uptick in the proportion of PE-backed deals versus the trend since the start of 2020. Now, there could be various reasons for this. It could be a statistical anomaly. However, without wanting to delve too deep into the session later, our best guess at the moment is this is possibly the first sign of a slight softening in the market. If we go back to May, when we had the last webinar, we started to talk about market uncertainty in the outlook, and we suggested that typically trade buyers would be the ones that might stop acquiring first, as they'd be more likely to be focusing on organic growth, making sure their internal strategies are correct, versus private equity-backed groups who often have a shorter time horizon and so need to keep growing both organically and inorganically. So that could be what we're seeing here. Moving back to private equity specifically, we're certainly speaking to new houses all the time that have an eye on this sector or wanting to get involved in this space. We had a call yesterday with a new private equity house that has a thesis that they're looking at and is considering an investment in the space. So that helps give us confidence that this is an attractive sector for investors over the medium term. The final point with private equity is the concept of a secondary transaction. So this is where a private equity house buys out an existing private equity house. So an example of this would be the Talon deal I referred to before. Typically, when private equity invests, they are targeting a transaction, whether it be an exit to a trade buyer or to another private equity house in a time horizon of about 3 or 5 years, typically between 3 and 5 years. Talon were bought by Mayfair in 2017, so that very much demonstrates that point. However, the main point here is that there were a number of Marcoms groups who took on PE investments in the years immediately prior to COVID, and so are starting to approach the end of their investment cycles. We can therefore expect to see a series of transactions of that nature in the next few years. So Brain Labs certainly have gone publicly announced that they have appointed an advisor to look for new private equity owners. What's going to be interesting is this the others who are in a similar position, if they sell to trade buyers or if they decide to sell to another private equity house when the time comes. If the majority sell to new private equity owners, that's likely to mean that the fragmented market remains and that the buy and build strategies will continue, giving us visibility about the direction of the market going into the medium term. In both Q2 and Q3, looking at the sectors now, the two front runners have been both. Sorry, in terms of the capabilities most sought after, the two main front runners have been both data analytics and advertising. We discussed data analytics last time, so now a slight focus on advertising, which may seem slightly counterintuitive in a period of where economic uncertainty has been on the horizon. However, agencies at a top level have been talking about continued growth in ad spending, pointing to a number of cyclical events very much in Q4 this year, the World Cup, the US midterms. So that could be one thing that could be driving it. Additionally, it could be the fragmented market. So there's very much a need for high quality advertising, creative capabilities. And with a fragmented acquirer landscape, there are a lot of different acquirers looking for a jewel in their creative crown. We talked about a couple of transactions at the start that we've advised on the last few months. So Preacher London in the sale to Candid, and AML and Selby Anderson, an ad agency and a creative agency. And they're both sold to acquirers by building exciting groups. I think the interesting thing about those two acquisitions is both of those acquirers are actually debt funded rather than backed by PE. So that very much demonstrates that PE, whilst if you sell your agency, you're most likely to be bought by a PE-backed buyer. There are other ways that acquisition strategies can be funded. Touching briefly on data and analytics, very much at the top of acquirers' wish lists, along with e-commerce capabilities, among others. One such acquisition in that space was Expert Edge by Havas. Havas are probably the only network they are definitely the most acquisitive network in terms of buying agencies. They made 3 acquisitions in the UK this year, Searchlab and Invika, and another couple. The other networks, their focus is generally more global and aren't really making agency acquisitions in the UK unless it's for really, really cutting edge digital capabilities or even tech capabilities. And we very much see that as the medium term trend. An example of where their networks are buying agencies is WPP. They bought a Latin American group last week, a comms group called Jeffrey Group, and that's probably a demonstration of the types of markets that they're wanting to get into. The other acquisition this year that WPP made was in the influencer marketing space, and that is a second area that's on the top of a lot of other acquirers' wish lists. Brain Labs were another to acquire in that space, buying Fanbytes over the summer. That then leads us to just touch briefly on B2C versus B2B. We're going to explore the topic in more detail a bit later, but there's a debate out there as to whether if there is a period of economic uncertainty, whether B2C is going to be more impacted than B2B. And of course, in the UK, there's 2 highly prolific B2B acquirers with Gravity and the Marketing Practice. And we mentioned the Marketing Practice earlier, but they've made 5 acquisitions between them over the last 2 quarters, focusing on ABM and ABX capabilities in particular. So definitely 2 groups to continue to watch. Just to recap then, so in our view, based on the numbers, which, as I said, are lag indicators, the market is currently very, very strong. Private equity are very active. There are a number of well-funded trade acquirers and digital analytics, data and analytics, e-commerce, advertising, specialist consulting capabilities, very, very sought after. We're going to discuss some of those trends on a more forward-looking basis after we hear the economic outlook. So what I'll do now is I'm going to hand over to Abbas, who we're delighted to have joined us from the markets and macro research team at Barclays. And he's going to help unpick what's going on at the moment and give us the latest update. So I think when we planned this webinar back in July, I don't think any of us were expecting the week that we've just had. So very much looking forward to this. So over to you, Abbas.
For the introduction, my name is Abbas, and I work here at the research team at Barclays, looking specifically at the UK economy. And I'll spend about sort of 10 or so minutes kind of briefly outlining, firstly, I think, the story so far. Obviously, we've had a succession of shocks in the UK. And then I'll sort of outline the general contours of the outlook and maybe delve into some of the key assumptions and drivers of this. But I'll finish by sort of discussing what we've seen over the last few days, which really have been rather historic. And I'll try to provide some of our kind of initial thinking about what it means in terms of interest rates, in terms of the currency and the outlook, etc. So with that, could we move on to the first slide, please? Great. So the top slide, I think, nicely demonstrates, where we've come from. And in short, what we'd like to kind of outline is that we're coming straight out of one shock, the COVID-19 shock, where you saw, quite historical contractions in the level of GDP. But we're bouncing right into another, which is the cost of living crisis. Now, the economy reopened sort of halfway through last year, and that led to sort of mechanical increases in the level of GDP. We obviously had the Omicron wobble, which didn't end up being such a big thing after all at the end of last year. But as inflation really increased over this year, households' real disposable incomes took a hit. Their purchasing power was effectively eroded. And during the sort of second and third quarter of this year, we kind of saw a situation where the sectors which were the last to sort of fully normalize post-COVID, so think of consumer-facing services, hospitality, leisure, etc., they were still doing pretty well. And indeed, over the summer, I think those sectors overall had a pretty good time of it, whereas other parts of the economy, so I think manufacturing and construction, etc., they did start to slow pretty significantly. So the net overall result of that was a period of slowing underlying growth, which is what you can see kind of circled towards the end of that top chart there. But the initial data for September suggests that kind of summer feel-good factor tailwind, if you like, for those consumer-facing services, probably has diminished now, and it does look like the economy, could already even be in a recession over Q2 and Q3, albeit a rather mild one. So looking at the outlook, which is kind of the second chart there at the bottom, that shows quarter-on-quarter percentage growth rates, and I think before kind of explaining that chart, it's important to highlight the context in terms of government support, and in particular, the energy price cap policies for both households and firms is extremely important and relevant for the outlook. So for reference, kind of in the absence of those interventions, household energy bills were set to be 5 times higher next year than they were a year ago. So clearly that would have had quite a detrimental impact on GDP. And I think it goes some way to explaining the difference in that chart between the rather bleak Bank of England forecast, which is what you see in the green, and our forecast, and indeed that of the Bloomberg consensus, which is that purple line there. So, but nonetheless, despite the intervention from the government, household energy bills are still set to be at elevated levels, if not the kind of astronomical levels that they otherwise would have been. And, in combination with a slowing international environment, keep in mind that it's very likely that the euro area is going to suffer a recession over the winter. we do think that the UK is likely to enter a recession over the winter, or even remain in recession if you believe that we already are in one now. But the slightly more optimistic news, if you like, is that we do think the economy should bounce back in the second half of next year and actually grow above its trend rate of growth. And that's largely sort of given the fact that we believe inflation is likely to fall away by that stage. And we may well see the kind of last remnants, if you like, of the kind of COVID-19 recovery, particularly in consumer-facing services. So go to the next slide, please. So I've kind of given you a broad outline of the contours of the outlook, but just quickly, I think it's worth discussing two key assumptions, if you like, which really will kind of drive the outlook going forward. So the first is around savings. So this is kind of a very well told story, and it's not just the case in the UK, but amongst many developed market economies, that during the pandemic, households saw a very material accumulation of excess savings, where effectively the story is that governments propped up incomes through in the UK things like the furlough scheme and enhanced benefits, but expenditure just simply wasn't possible because sectors were closed down. And in aggregate, we think that households saved around 10% of GDP's worth of what they otherwise would have done in terms of savings, right? So if they're all spent at once, that could be a pretty powerful tailwind. Now, the evidence so far is that households have probably been a little bit on the cautious side. So we haven't actually seen savings rates fall below pre-COVID levels just yet. But to be clear, in a high inflationary environment, you actually do need savings rates to fall below those levels just to sustain the same level of consumption, right? So we would expect savings rates to drift lower, but in large part, the extent of that will depend on consumer confidence, which, if you look at various data sources at the moment, are at or below kind of the lows that we've seen in the last multiple decades. So there is a risk here that households, decide to retrench a little bit. And, if so, that would kind of exacerbate the slowdown and indeed the recession that we expect to see over the winter. Now, the second factor is around wage growth and the labor market. And simply put, with inflation continuing to eat away at households' purchasing power, you do need higher nominal wage growth to offset this and sustain consumption levels. And in the UK, we have seen relatively high nominal wage growth, certainly more than what we've seen in, for example, the euro area. Albeit when you look at the drivers of this, which is kind of nicely shown in the chart on the right, at the bottom right, it does seem to be because of a lack of labour supply rather than super hot labour demand. So there you see that the level of employment is actually below its pre-COVID level, because many people effectively left the workforce altogether, and that's the kind of green line there with the high level of inactivity. But nonetheless, if wage growth is sustained, particularly as inflation starts to come down, then that could be a boon for household disposable incomes and, by extension, the outlook. Next slide, please. Right, so coming on to the events of the last few days, I think it's probably worthwhile quickly kind of outlining what on earth actually happened here. So it started on Friday. As you will have seen, the government came out with a so-called mini budget, albeit with maxi consequences. Now, I think if we actually look at this budget, there are kind of two halves to it. So the first was the kind of temporary energy support policies, where kind of, as I mentioned earlier, the government have capped energy prices for households and firms over the next 2 years. And the cost here is pretty uncertain because it effectively relates to what will happen in wholesale energy markets. But based on kind of levels that we've seen over recent days, it could be up to 8% of GDP's worth of extra government borrowing over the next 2 years. So clearly significant, although the interesting thing is that the market reaction to all of this was probably less directed to those kind of temporary energy measures, but more towards the sort of permanent tax cuts, which we also got at this budget. So here we're thinking about, the reversal of the national insurance contribution rate rise, the cancellation of the planned increase in corporation tax next year, but also a range of other measures, income tax changes, stamp duty, etc. And if you sort of tally them all up, then that totals to around 2% of GDP's worth in extra borrowing per year. Now, it's interesting that in terms of the sort of surprise relative to expectations, we only, I say only in kind of inverted commas, we only got about £10 billion more in tax cuts, that's around 0.5% of GDP per year than what we were expecting, because it was pretty well flagged that the national insurance contributions and the corporation tax rates would be reversed. But, nonetheless, despite that, I would say, relatively, not insignificant, but relatively small surprise, the government bond markets and the pound did sell off quite violently. And our sense is that it may have reflected more perception rather than economic fundamentals, namely the fact that, given the lack of an OBR official kind of budgetary responsibility forecast in terms of where the economy is going, what it means for kind of tax revenues, etc., there is a sense that the government has lost its commitment to fiscal sustainability. And indeed, our forecast for the debt to GDP ratio, which you can see on the right, has it drifting higher to around 105%. If you actually compare that to peers, it doesn't really stand out, but I think the relevance here is that it's on a continually upward drifting path, and that's probably what has spooked markets. Now, there were calls for an emergency kind of intermeeting hike by the Bank of England as early as this week, but those were kind of shot down by both the governor and the chief economist in statements on Monday and Tuesday. So our base case is that the next move will likely be at the next meeting in November. But as those debt markets sold off, we did begin to see certain dislocations in market functioning, particularly in things like mortgage markets, but in particular amongst the pension fund community. They tend to use longer dated government bonds to hedge certain liabilities, and the huge moves that we saw effectively meant that a lot of those derivative positions got unwound, which basically exacerbated the sell-off. And this led to the Bank of England's actions yesterday to effectively restart quantitative easing, albeit on a temporary basis, just to calm down that particular, narrow section of the market. This did seem to have the kind of desired impact. We saw the market, move very heavily yesterday and kind of broadly stabilize. Can you move to the next slide, please? But, how do we interpret all of this in terms of, where we're going from here? I think, our take is that even though the fiscal measures are clearly a demand shock, the fiscal loosening is likely to be inflationary, albeit maybe not a huge material boost to GDP, given that the measures are rather untargeted. But nonetheless, given the inflationary impact, it does mean that the bank will have to tighten interest rates further. But the bank's actions yesterday do suggest that they're unlikely to tolerate a pace of tightening that will lead to financial stability risks, which, in our view, the current market pricing, which you can see on the bottom chart there, does risk, right? So the market has bank rate going up to 6%. So in contrast, looking more at the fundamentals of this package and its impact on inflation, our central case is for the Bank of England to hike by 75 basis points at the next meeting in November versus a kind of market pricing of in excess of 150 basis points. And then another 50 basis points in December, followed by rates on hold at 3.5%. We do see some upside risks to this, potentially in 2023, but to be clear, if they do hike by more, it's likely to be at a much more gradual pace. So think back to the sort of maybe 25 basis point hikes that we're used to seeing pre-COVID. I mean, the impact of the fiscal policy feeds through to the economy rather gradually, and therefore calls for a more gradual monetary policy response. Clearly, however, the risk in terms of the outlook is for a far more aggressive pace of tightening, which would lead to a more pronounced slowdown over the next year and into 2024. Finally, and I think I'll end it here, it's worth pointing out that if the bank doesn't tighten as much as markets expect, and perhaps more in line with what we are expecting, it does mean that there will be downward pressure on the currency. Fundamentally, the problem here is that UK assets need to become more attractive. And if the Bank of England aren't going to do that by hiking interest rates, then the currency effectively becomes the release valve. But I think with that, I've probably spoken over my time. I'll stop there and I'll hand it back. Thank you.
Thank you very much, Abbas. A fascinating oversight there. Let's hope that Barclays predictions are correct rather than the market predictions, which take interest rates somewhat higher. So I think firstly, before we dive into the M&A, Fraser, what are your clients saying about what they're experiencing generally? I mean, given they are some of the bigger players in the space, they're probably fairly good bellwethers. Are they seeing any slowdown as a result of this sort of economic turmoil that we're in?
No, I think is the short answer. I think obviously there's a lot of uncertainty in the market, and there's a lot of nervousness amongst businesses about what might come. But I've got a portfolio of clients of my own. I work with a team at Barclays. We've probably got a view across about 100 marketing companies just in the London area, and we're not really getting any live feedback that clients are cutting budgets just yet. I think Christmas and the festive period is going to be absolutely key. I think what is also giving people a bit of confidence is we've just been through the pandemic and people know how to cut their cloth. So I think people have got a bit of confidence that if they do take a dive, having just been through it not so long ago, they know exactly how to react and get themselves shipshape quickly.
Yeah. What about you, Paul? What are sort of the MKS clients saying? Are they experiencing any cutbacks or pauses on spend?
I think it's very similar to what Fraser's saying. I think the main message that's coming out of our client base is the biggest challenge is actually recruitment. And alluding to a couple of, obviously Abbas's slides referenced that at the start. Retention, I think, is coming up less, and that's potentially because of the what's in the press about the macroeconomic conditions. Employers are possibly less likely to move when there's periods of economic uncertainty. So hopefully that is helping agencies. I think the biggest concern the agencies that we speak to have is around wage inflation, and then the knock-on impact probably more next year, and then what the follow-on implications are in terms of profitability and positioning for exit is how and if that inflation could be passed on to clients. Now, the most successful agencies, those that have a non-commoditized proposition, those which are seen as partners with their clients, will be able to do that to a greater extent, and so those will be the ones which will be in a very good position to be able to exit all of the things, obviously considering every other things. In terms of revenue, I think clients, I think I've only spoken to one client who has seen any slowdown. That was yesterday. Everyone else in previous weeks, it was all talking about staff, but everyone is very mindful and everyone is primed that there may be a difficult winter ahead. In terms of acquirers, I have spoken to a couple who have mentioned in conversations that projects are starting to slide to the right somewhat. Although, and again, this is maybe somewhat anecdotal in terms of geographies, they think the UK and the US are potentially the ones that are where they're expecting there to be issues there more so than Europe and Asia. But yeah, consistent with Fraser.
Yeah, certainly that's what I'm seeing across my client base as well. In Kat, I mean, private equity use portfolio theory to sit across lots of different sort of verticals and service lines. What are they seeing about what they're seeing currently?
So from the private equity funds that I've spoken to, actually portfolio companies haven't felt the effects that Paul, Fraser and Abbas actually mentioned. So wage inflation, recruitment. So PE businesses typically invest in people businesses, and when they do make that investment, they instill really strong people strategies. And when they do that initial investment, so that protects them against these exact issues. However, with uncertain times coming ahead, I think we will see a shift of power from employee to employer as job security definitely becomes a bit more prevalent. In terms of verticals and service lines, the private equity firms we usually talk to, they don't invest more than 4 to 5 sectors, and those tend to be business services, healthcare, technology, all of which are pretty recession resilient. However, post-COVID, as Paul mentioned earlier, investment has definitely shifted from B2C to B2B. So I think it's funds that hold consumer businesses that will definitely start to feel the effects of the slowdown.
Yeah, I would have thought so. I would have thought so. I mean, that brings us nicely on to acquirers, Fraser. I mean, Paul mentioned earlier that sort of non-private equity backed trade buyers are often the first to stop acquiring in times of economic uncertainty. Have you seen this at all with any of your client base?
I think the most obvious one we've seen is in PLC names. You know, equity markets have taken a hit. They've seen an impact on their valuations, and that makes it harder for them to use shares as a tool or as a funding source for deals. You think about people like S4 Capital have got a very widely publicized model of 50% cash, 50% shares, and they've locked in what that share price is that they're willing to deal at, and it doesn't work now, so they've pressed pause. And then we've seen Next 15 PLC had a very credible offer on the table to buy M&C Saatchi, and it was supported by the board, but then because the market went against them, share price came down and that deal no longer made sense. So we're waiting to see whether it happens, but it looks unlikely now. So there's a number of acquirers in this market that are listed names that have lost that ammunition that they have. And I also think that people looking to sell their business are going to look more closely at, do I want cash or do I want a mix of cash and shares? And if I'm being bought by a listed business, where's their share price? Where's it likely to go? And actually, it doesn't even necessarily matter too much what you think of that business, because if the market shifts, you get impacted anyway. So I think vendors are going to want to think carefully about how they feel about shares as part of the package.
Yeah, I would imagine so. Kat, what's private equity's view of the M&A market now? Does it sort of depend whether it's a sort of a buyout or a bolt-on? And what, I mean, if we look ahead to the next 12 months, what are they expecting?
It's absolutely for sure. Its fundraising has remained really resilient. PE are holding record levels of what we call dry powder, so cash that they can spend on making company investments. So right now it's about 3.6 trillion versus 2.5 trillion that we saw for pre-COVID levels on a worldwide basis. So deal flow momentum is definitely going to remain high. I think what we'll see is a little bit of tweaking in investment strategies. So there'll definitely be a bit more scrutiny when they screen businesses. So, I mean, they always do. They always look for, you know, strong client base, income security, recurring revenues, long-term contracts. But I think a bit more emphasis will be on cash burn. They'll also start to do a bit of digging into how businesses will react to the recession. So where they're going to cut costs, and, you know, if it's big areas, whether that will be considered a red flag. But right now, no prioritization between platforms, businesses. So that's basically when a private equity makes its first acquisition in a specific market versus bolt-ons, i.e. the acquisitions they add on to that platform. However, what we did see during COVID, which we may see in the coming months, will probably be a shift to focusing on their current portfolio businesses. So deploying more capital, strategy changes, coupled with probably seizing easy growth opportunities where as valuations start to come down. Paul mentioned earlier that private equities investment cycles typically 3 to 5 years. So those that are looking to exit now may hold on to their portfolio companies slightly longer. Either that's selling, typically either they'd sell on to another private equity, but they're unlikely to get the same valuations that we're seeing now, or they list businesses that they currently hold, but as we've seen, the IPO market's slightly dried up. So watch this space.
So questions come in saying, as interest rates rise, what impact is this going to have on the PE market, their model, and therefore their appetite for acquisitions and the price that they might want to pay? I mean, maybe Kat, that's one.
Yeah.
You.
Well, interest rates definitely are going to prove a bit more of an enduring challenge to private equities buyouts playbook. Historically, we've had cheap debt, and that's been a real red flag or red rag to the private equity bull, with pretty much half of buyout transactions typically funded by debt, because this really emphasizes investors' return. However, unlike the financial crisis, bit of positivity, debt fundraising has continued to remain buoyant from debt funds. So sorry, Fraser, but alternative funding options versus mainstream banks, who definitely are still continuing to provide that line of credit. So I think we will see private equity using those to continue fueling buyouts. That being said, I mean, we can't beat around the bush. Interest rates are probably going to rise in response to inflation. So debt is going to become more expensive. In response to that, I think we'll see PE either having to put their hands deeper in their pocket or seek more private investment.
Another question is coming saying, to what extent do buyers like or dislike debt in a business acquisition target?
I mean, talk to that, Esther. I think they're generally quite neutral to it. It might even be seen as a positive that the business has been able to raise debt in the past. Typically, when a business is bought, the debt figure is deducted from what you pay for it. You value it exactly the same. How profitable is the business? What's it worth? And then when you come to pay that price, you knock off the debt, and that debt typically will be repaid because whoever's buying it's probably going to overlay their own debt structure. So I don't think it's a negative at all. It's likely that it will fall away unless it's some sort of working capital facility that needs to stay in the business, in which case it'll be largely ignored. But yeah, if anything, I would say it's a positive that it shows that a bank or somebody has had the appetite to lend to that business before, and it tells a buyer that actually, as I buy this company, I can raise some additional debt off the back of what I'm buying, not just off the back of what I can raise myself.
And in terms of you know, the sorts of businesses that the private equity firms are looking to buy and capabilities, what's sort of hot at the minute, Kat? I mean, is it sort of broadly consistent with some of the hot areas that Paul talked about earlier, or are private equity looking for something different?
Oh, absolutely. Coincidentally, I always think of private equity always following trends, not too dissimilar to influencers, actually. So, for example, after COVID, we obviously saw a huge influx of investment in digital transformation, e-commerce. But right now, what we're seeing in the marketing space is absolutely demand for customer experience and data-driven businesses, which are driving more personalized marketing strategies. So data analytics, research, insights, benchmarking, AI platforms, those sorts of areas are really hot sectors at the moment. I mean, outside of the marketing world, you've got your cliche sector areas like healthcare, like I mentioned before, business services, businesses that are scalable, fragmented, offering a digital offering in their services, those kind of areas.
And Paul, is that reflected across the whole of the market, or are there any differences with sort of other trade buyers?
No, I think it's fairly similarly aligned in the market as a whole in terms of what capabilities are being sought after, particularly because of the mid-market in terms of the more traditional trade buyers are not the same trade buyers who were dominating the markets in sort of the early 2010 to 2015 period. So it does mean that you do tend to get clusters of buyers competing after a few capabilities, and that's certainly what we've seen in some of the processes that we've been running this year. Yeah,
okay. We should probably talk a little bit about valuations and deal structures. Obviously, everyone's always very interested in what that looks like. Are you seeing, I mean, Paul, are you seeing any difference in deal structures, any new interesting ones that are being put in place as a result of all the economic uncertainty?
So I wouldn't say at the moment. I think at the moment the economic uncertainty isn't feeding through to deal structures, but it's very much there's a definite lag on that. Yeah. However, this year and this is more driven by the fragmented market. We are seeing the most divergence in the biggest divergence we've seen in terms of the range of deal structures. One sale process we were running earlier this year. We've received 7 offers, and you'd normally expect, if you receive 7 offers, you would normally expect them to cluster around a fairly traditional structure of maybe 40-50% cash up front, 3-year earn out, the traditional marcoms deal structure. However, each of the 7 were all completely different. There was at one extreme, there was one offer which was 100% cash and shares at close. At the other extreme, there was a very good cash percentage at close, and then a non-financial based KPI at earnout, and then a complete mix in between. So we're seeing a big range. Anecdotally, we're hearing some acquirers are changing deal structures. I think it's inevitable over the next few months. If I was an acquirer, I'd want to take the risk out of a transaction through a period of economic uncertainty. What we saw through COVID actually was more was being taken to the earnout. Valuation wise, certainly first half of the year, valuations have been very strong, but it has been quite asymmetric. It's been, I think, if you had a highly sought after capability, you would get a very high multiple. Acquirers now acquire less businesses that have got to a certain scale, so more traditional capabilities, you haven't seen those higher multiples. So there's a big divergence at the moment. In COVID, actually, and this is maybe what we'll see again, in the most sought after capabilities, there was almost a reduction in supply and demand, and they sort of balanced each other out. So valuations held up. And in some instances, actually demand outstripped supply because there weren't enough willing sellers because they were sort of sorting out their own businesses compared to the number of private equity backed buyers looking to buy capabilities. So particularly in the sort of back end of 2020, first half of 21, that actually helped valuations. So definitely asymmetric. One thing we really hope we don't see, and we didn't see in COVID, even though we thought we would if we rewind back to May 2020, was much distressed M&A. That was due to the government support last time. That's a big unknown now, what's going to happen over the next 6 months. This is big cost pressure, and if income starts to be impacted, then hopefully this won't be the case, but it may see some businesses struggling, and then there may well be sort of opportunistic buyers who are able to make distressed purchases.
And what about private equity? I mean, as we've heard, we sort of do expect them to continue to acquire throughout the downturn. So do you think there'll be a key driver of any change in deal structures or pricing, Kat?
I think, like Paul mentioned in his slides earlier, one of the things to just pick up before is that there was always this perception that trade buyers would always outbid PE, but PE have entered the market, well, we're just starting to enter the market pre-COVID. And after COVID specifically, you know, they were really after media marketing agencies purely from the shift of, you know, project based and becoming more of a partner and gaining retainers from those clients and building up platforms with SaaS models, etc. So I think now with the sheer weight of money raised by PE in the last years, PE have absolutely been able to outbid trade buyers regularly. I think as we've seen quite a high valuation environment over the last couple of years, I think we'll start to see a slight correction in multiples as we enter a slowdown. Probably will take a couple of months for this to wash through, as there's always a pricing lag between the private and public markets. But I think how will PE react in terms of valuations? I think they always in recessionary times see this as an opportunistic time to capitalize on declining valuations, like I mentioned before. So they might try and do easy wins with bolt-ons for their platform businesses. However, that's not to say those that we've spoken to have said that they will be willing to pay premium multiples for businesses in those desired verticals and capabilities, for sure.
Yeah. Fraser, I mean, often, you know, lots of deals are financed by debt, and you presumably help businesses do this. What impact is the interest rate rise going to have?
Yeah, I think from a pure credit risk perspective, mainstream banks have always taken the view that marketing advertising is a cyclical industry that kind of goes up and down with the economy, and that's always been baked into our lending appetite. So if you see a sort of vanilla bank lending structure, the business is typically not borrowing more than 2.5 to 3 times, even at a push. And the good news is that also means that banks don't need to make a knee-jerk reaction now. And we didn't see that during COVID. We carried on lending to businesses who were performing well during COVID. You know, digital marketing companies that continue to see growth, we carried on lending to them. It wasn't like what we saw in the financial crisis when the tap got turned off. So I don't envisage that seeing that now. Obviously, the cost of borrowing is going up. And as I say, we've had that baked in for a long time. We've always assessed lending at an all-in cost of about 6%. Worryingly, we might get a little bit above that if you believe what some people are saying. But a lot of this is already baked into our assumptions. So I certainly don't think it turns off the tap. I think what people will see is that private equity, because of the way the valuations have gone in recent years, bank appetite just has not kept up with that. You know, we've gone from people paying 5 times to 20 times for a business, and our appetite for lending hasn't really gone up at all. So what private equity have done is they've turned to institutional debt funds who are prepared to put much racier structures in at 4, 5, 6 times leverage. But those facilities have been priced at anything from 6 to 10% over cost of funds, and that cost of funds is getting higher and higher. So I think those structures are going to have to change, and private equity are going to have to write bigger equity checks. Luckily, it sounds like they've still got lots of dry powder to do that with.
Oh, I tried to ban that phrase.
Yeah.
You both used it.
But yeah, look, debt is still there. Even if we see the recession that people are talking about, there are always winners and losers. As we saw during COVID, some businesses absolutely kaboomed during COVID, and we were there to support them through it, as well as we were there to support those who were struggling. So I just don't see taps getting turned off. People just need to be sensible in what they borrow.
Good. That's what we like to hear. That's what we like to hear. What about the falling value of the pound? What sort of impact is that going to have, Fraser?
I think the obvious one and the positive is that UK PLC looks really cheap now. So you would hope that valuations are going to be propped up by the fact that overseas buyers, and particularly US buyers, can see a bargain. I think it's acknowledged that we've got a great creative marketing sector here in the UK that they still want to invest in, and it's now cheaper than ever to do so. I think the bad news for people is if you want to expand abroad, that's going to get more expensive. I think it's as simple as that, really. Yeah,
I think that's absolutely right. Paul, what's your view?
Yeah, absolutely. Completely agree with Teresa. And actually, before the events of the last week, we've got a record number of transactions where we're selling to a US buyer. Each of them have got different reasons. I'm sure the strength of the dollar helped them in their pricing decisions. So I could see it being absolutely. If I was a US buyer, I would see it as a big opportunity, as Fraser mentioned, due to the strength of the UK creative industry.
Yeah, absolutely. And finally, I think we'll just pull you back in at Abbas just for a final comment. We've got 2 minutes left. So we've talked a lot about the short-term impacts, but what about the medium-term view on the market, Abbas? What's your thoughts on that?
Sure, thanks a lot. So I think when answering that question, quite a useful hook is clearly kind of the government's 2.5% growth target off the back of this budget, right? And the question is what they've announced going to help to achieve that? I think the traditional way through which you would look at kind of fiscal loosenings from an economics perspective is, do these measures have relatively high multipliers or not? Now, in terms of kind of the measures that were announced kind of in the more immediate terms, things like tax cuts, etc., unfortunately, the answer is that they tend to be a bit lower than things like kind of infrastructure and investment spending, particularly when tax cuts focus amongst kind of richer households who in general tend to have a lower marginal propensity to consume. However, I don't want to be too gloomy, and I think maybe where, let's say, the ray of hope is here for the more medium term is that the government have announced, or at least have kind of put out tentatively, more kind of structural policies, things like deregulation, things like investment zones, and we don't like to kind of poo-poo things too quickly, but the fact is we don't have that much detail just yet on these things. So I think that the key thing to watch looking forward is what detail will the government give us for these more kind of structural policies, and we certainly don't rule out that they may have a good positive impact in the medium term, but I think it's more of a kind of watch this space.
Thank you so much, Abbas. Thank you as well, Fraser, Kat and Paul. I think that is a wrap. It's 11 o'clock, fascinating discussion. We probably could have gone on all day talking about what the economy has in store and the impacts on the M&A market, but I'm sure all the members of the panel today will be happy to pick up any individual questions that you have. If you wish to email them, contact details will be made available to you. Like I said, there'll be a recording available. Please share this with your peers. I'm sure this is relevant to so many people, in addition to those that have joined us today. So thank you very much for joining us. Enjoy the rest of your day, everybody. Thank you. Bye-bye.
Thanks all.